Welcome to Invest Nivesh. Today I'll be talking about financial planning for young investors. Also, I'll be talking from the tax planning perspective as well. So, let's begin. So, basically, where to invest for young investors. So, I think these are the key four options for them. One is the liquid funds, the funds which you invest in a way so that you get better returns from your saving accounts, because typically you get 3 to 4% in your saving account. Some banks might give a little bit higher, but liquid funds can give as high as 8% before tax, and still post tax you can get 7%, I think, in liquid funds. So it's a good option. The other option to invest is in tax saver deposits, wherein you will be getting money tax free. All the principal investment is done, the interest is still taxable. So I'm not telling to invest a large amount, but a little bit amount is required so that you can maintain a healthy debt equity balance in this. So the key investment will be after this will be the equity funds. So basically you will be doing your investment in your ELSs, which is equity linked saving schemes, wherein the investment will be locked in for 3 years, and you will be getting tax benefit for your principal investment as well as the capital gain which you will be having in this, which is the good thing in comparison to other investments, because no other investment will be giving you both the things for a shorter duration, for locking period, because all other investment has a larger locking period. The other investment in equity mutual fund you should be doing is in large cap funds, mid cap funds, small cap funds, as well as multi cap funds. And since you are not doing any investment in stock market, I will recommend a small investment in stock market. You should try to understand and identify the key opportunities, and at least do it from a long term investment perspective and not to do trading in that. So things to remember in this is like you should buy direct plans for mutual funds so that you can increase your overall returns. You can check out a video I have made to do a comparison between the direct plans as well as the regular plans. And you should do lump sum investment every month for your ELSS. The reason behind is that because ELSS is under Section 80C, and it's difficult to plan how much amount your Section 80C will have a ELSS component. The reason behind is that as your salary increase, if you're a salaried employer working for a company having employees of about 20, or maybe employee company which provides provident fund, your provident fund will typically increase every year based on your increase on your salary. So since there is a portion of your salary, your contribution in the provident fund is considered under the Section 80C, so you get a tax benefit in that. So you should reduce your ELSS investment accordingly, and then move your additional money left of ELSS to a normal mutual fund, like large cap, mid cap, small cap, multi cap, and you can do a SIP there. So you can invest in ELSS based on your need base. I will say need based investment is required. And so if you don't want to invest in tax free deposit, the other alternative is that you invest in tax free bonds. But the tax free bonds are basically the one which comes new. I'm not recommending you to invest in existing tax free bonds, because it's always in a higher premium range, and overall your returns wouldn't be much high. And you can even invest in PPF if you want that tax free deposit amount, if you don't require money immediately. Moving forward, so apart from these investment, you need to do certain expenses, I will say, because these are not investments. Insurance and investments are different. It's required to be kept separate, don't club it. So in insurance, you should buy term insurance, at least 50 lakh to 1 crore for these kind of age zones having these kind of salary and lifestyle. So this should be costing you anywhere around 8,000 rupees. So higher the better, higher the term insurance amount, term insurance value is the better. And I would recommend that you don't buy directly from the company website. Reason being is that there is no price advantage, like if you buy from a company website directly, or if you buy from a comparison website like CoverFox, Policy Bazaar, so the price will be remaining same. So it's better to buy from a policy bazaar and covered for, because they will be assisting you in the whole process, as far as getting the insurance eventually. And also after that, when anything occurs, they will help you, your family members, because you had purchased through them. They will assist you how to get the claims and all. So it's better to buy from, from the comparison websites. And for health insurance, I'll recommend that you buy from a broker. Reason behind is that in terms of the duration of illness and all, your broker, because he has processed multiple claims in the past, he will have the expertise to process your claims. And since this amount is not that much big, it won't be hurting you in terms of commissions and all. And I think, as far as I know, overall cost of your premium for a plan brought from a broker and bought online, there wouldn't be much of a difference. So there is no price advantage, I think there is. So it's better to buy from a broker. So, to give you a more further understanding, I have taken one example. So, Suresh is employed in a private sector company and earns around 5 lakh rupees a year. His salary also includes 48,000 of provident fund and 96,000 as housing and rental allowance. And his monthly expenses include, like, he incur around 8,000 rupees as rent, living. For food, he spend around 4,000. For transport, he for the spend 2,000, and other miscellaneous costs will cost around 2,000. So total monthly expense is around 16,000 rupees. So he, a balance amount, whatever he left with, he wants to invest in a such a way that some money can be liquidated immediately, and he is financially secured as well. He also wants to save tax. I think everyone wants to save tax, so this is also important for everyone. So what I think he should be done by him is that first he need to calculate his net savings. So his net savings will be the 5 lakh minus the expense he's going to incur. So it's around 3 lakh 8,000 rupees. So first thing, he should basically have a breakdown of his section 80C declaration. So since 24,000 is the amount which will be showing in section 80C as his contribution, as if your PA has a 50% contribution of the employer and 50% contribution of the employee. So he has a 24,000 benefit there. And since he's buying term insurance, that comes under section 80C benefit, he can claim that as a tax benefit. And he needs to invest around 18,000 in your tax saver fixed deposits, and the balance 1 lakh rupee he has to invest in ELSS mutual fund. Now this section 80C 1.5 lakh rupees will get basically changed every year based on your increase in salary. So based on increase in salary, your PF contribution will increase. So as your PF contribution increase, you should reduce your tax your FD investment, or you can reduce your ELSS mutual fund investment. So you should tweak accordingly as your salary grows. And apart from this, there is section 80D where you can claim the health insurance premium is going to pay. So I have counted as 5,000 rupees. Typically, it will be for a, let's say, around 5 to 7 lakh of a health insurance mediclaim plan. So now, apart from the expenses he's going to incur, these are the basically the mutual fund investment he should do. So you should choose one fund from each category. So he should invest 2,000 in a large cap fund through SIP, mid cap fund 1,000, small cap 1,000, multi cap 1,000, all SIPs. So this will help to have a good amount of balanced portfolio. He can, if he's not that much risk averse, he can switch from, let's say, he can take one balance fund and remove a small cap fund. That tweaking he can do. This will help to create a good amount of investment and a good diversified portfolio. And overall his SIP investment will be around 60,000 a year. And apart from that, I would recommend him to invest in stocks, at least one or two. Amount should be around 20,000 a year, so that he can basically, if he has selected a good stock, can generate good returns from a long term perspective. And he should invest 24,000 in liquid funds, let's say around 2,000 rupees every month. uh, I would recommend that in liquid fund, like these days there are several apps wherein just you need to swipe from your account and give some certain details. Automatically that money get transferred to your liquid funds. I think Birla Sun Life and Reliance has these options. So and when you want to withdraw that liquid fund, in a day or two the money gets into your bank account. And Reliance, I guess it's much faster. Within 24 hours they give the money back you're invested in liquid funds. So I will recommend a 24,000 investment there. And in saving account balance, it will be around 25,000, around 2 to 2,500 every month. You can, eventually there will be in your account. So that will accumulate in a period of time to 25,000 rupees a year. So now, from tax perspective, if you do these kind of investment based on what I have recommended, uh, I don't think you will be required to pay any tax. Like because tax-free income is 2.5 lakhs currently for person of these kind of age. And since you will be doing 1.5 lakh of section 80C, you'll be getting a 5,000 for section 80D and HRA of 96,000 and PF of 24. The total benefit of tax you have 5.25 lakh and your income is only 5 lakh. So basically you won't be required to pay any tax. That is a good thing. And also the only tax I think you will be paying is the interest if you have generated in the liquid funds. Let's say you are redeeming that amount. If you want to go to a holiday, let's say, for that you will be paying some tax, and that won't be much. I will say it will be very less. So now wanted to give you a small salary utilization breakup. So your salary is 5 lakh rupees, out of which 1.92 lakh is going to your expenses, and 5,000 for health insurance, 8,000 for life insurance, 48,000 for provident fund, both employer and employee contribution, because both of them goes from your salary, and 1.08 lakh in SIP in equity mutual funds, stock investments around 20,000, ELSS in mutual fund around 60,000, tax saver FDs of 18,000, liquid fund of 24,000, cash in your saving accounts in 25,000. So basically, this breakup will tell you like the money you have, since everything will be tax free, and the money eventually is getting no utilized. Both are same, so there is no discrepancies in that. So I hope you like this video, and I just want to share you a quote from Benjamin Franklin that a penny saved is a penny earned. So make sure you save and earn as well. So thank you for watching this video. If you like this video, please hit the like button, and you can comment your queries, and I hope you subscribe to my channel so you are aware for more other information in investments. Thank you.